Today, we're going to be diving into the topic of how to leverage life insurance to become your own bank. It is a very popular topic that is getting discussed on social media with all the creators that are out there now able to make content about this. It is something that has been a tactic really since the 1980s. It all goes back to a gentleman named Nelson Nash. He started the whole idea of what we call infinite banking back in the early 1980s. And it's basically the concept of utilizing cash value life insurance to become like a bank account or a savings account for yourself. So, but basically, it's the concept of utilizing permanent life insurance and overfunding the policy so that you can get access to that money at a later date. So, I'll kind of give you the backstory on it. But many, many years ago, this product or this concept was started with whole life insurance policies. Whole life insurance policies have literally been around for 100 plus years. They're the oldest kind of permanent life insurance you can own. Um, and the concept of overfunding them is credited to Nelson Nash, where nowadays what you can do is you can actually overfund the cost of that policy, and that is going to grow cash value inside of it that you can then access in the form of a loan later in the future, all tax free. So people like it because utilizing cash value life insurance is a lot more flexible than using other types of investments that you can leverage, and versus you compare it to like a basic savings account where you don't earn any interest. At least on the life insurance side, right, you're earning interest, which is great. So nowadays what we use probably the most on this infinite banking kick, or what we call be your own bank, is really a product called an indexed universal life. So I'm curious if you've heard of an indexed universal life. Give me a one in the chat so I can kind of see what our viewers are aware of. But IUL policies right now are hands down the most popular product on the market today. And basically, the concept of utilizing them to become your own bank is again overfunding the cost of that policy. So, for example, like let's just say somebody were to get a $500,000 life insurance policy. Let's just say that the cost on that was $100 a month. This is obviously just for example purposes. And let's say that the maximum you could contribute into that policy per year would be, let's just say, $1,000 a month. So the way they work is the more life insurance you get, the more money you can put into that policy. The less life insurance you get, the less money you can put in. So if your goal is to use the policy to become your own bank relatively pretty quickly, then you want to be designing the life insurance policy where you're getting the least amount of life insurance required for the maximum amount of money that you want to be putting into that policy per month or per year right away. So with that same example, if the maximum you could put into that policy was $1,000 a month, right, and we're looking at a $500,000 policy, if you want to use that plan to become your own bank, you want to be contributing as quickly as you can that $1,000 a month, because that's what's going to help the cash value grow very quickly. It will still grow if you don't put in $1,000 a month. You could put in 500, you could probably put in $250 a month, and it would be just fine. It just means you're not going to have access to as much cash value as quickly as if you were putting in closer to that maximum number. So again, this is kind of called I don't want to necessarily say that it's called infinite banking, but the buzzword on social media today is infinite banking. And infinite banking is not a product, it is just a concept on how you utilize a product that's already on the marketplace. So if your goal is to maybe, I should say, when I sit down with my clients, I always talk to them about their short term, midterm, long term goals. And I'll say, okay, in the next 2 to 5 years, what are some things that you want to do that cost money? And then let's forecast maybe 5 to 10 years down the road. And then let's forecast maybe, 10 plus 20 years down the road. And let's see what are some goals that you have and what is the amount of money that you would need to accomplish each goal. And then we'll look and see, based on their budget, would a plan like this make sense? I will say what is popular about them. Not only are you able to put money in and get it back out relatively pretty quickly without taxes, penalties, or fees, depending on the company you choose to go with. And do not ask me which company, because all companies are different and the company is going to depend on you, the client, your age, your health history, and your background. But I will say a handful of companies today offer a feature that is called either an alternative or a participating loan. Give me a two in the chat if you have ever heard of alternative loans. I'm just curious how many people have heard of them. So, usually with insurance policies like IULs, you're going to have a couple different ways you can access money out of them. You can withdraw out of the policy. If you do withdraw out of the policy, not an issue. Money that you put in without any taxes, penalties, or fees. If you try to withdraw out the interest that you earned inside the policy, that's when with taxes because it's considered interest, right? However, how we get around all of that and what keeps these policies tax free is we focus on loan types. Usually, you're looking at like a standard or what they call a declared loan compared to an alternative or what we call a participating loan. Some insurance companies today now offer both. There are some insurance companies that still just offer the traditional standard declared loan. But if your goal is to use this policy to really truly become your own bank, kind of do like infinite banking, things like that, then you want to be working with an insurance company that is going to be offering you participating indexed um, loans, right? Where you have access to that money in a very, very specific way. So with alternative index participant, yes, just to make it more complicated, every insurance company calls it something different, but for the sake of today, we're just going to call it a alternative loan. So if you have access to an alternative loan, what that means is the insurance company will actually loan you their money. They will use your money inside your policy as collateral for that loan. You go take the money from the insurance company and you go and invest it, you purchase some property, you expand your business, whatever it is you want to do, and then you can pay off the loan whenever you want. The cool thing about it, as compared to taking money out directly from a bank, because if you were to borrow money from a bank, there's going to be a loan repayment agreement. You're going to have to give that money back to them in some way, shape, or form at some time. With the insurance company, there's no loan repayment, there's no terms to the loan. You pay it back as soon as you can, right? Obviously, the sooner you can, the better for your account. But at the end of the day, there's no terms to it. So, for example, if you have $100,000 inside your account and you choose to take out, let's say 80,000 of that on an alternative loan, your account value is not going to drop down to 20,000. That's what would happen if you were using a 401k and taking a loan from that. But your account value is actually going to stay at 100,000. The insurance company will loan you 80,000 from them to you. You go and do whatever you want to do with it, and then you pay that loan off whenever you can. Now, it's not too good to be true, right? It's just too good to be free. So those loans are not free. The most insurance companies will charge you somewhere between maybe 4 to 5% interest per year. Usually it's simple interest per year until that loan is paid back. But think, I mean, if you're investing it somewhere and you're earning 7, 10, 15, 20% on it, you're making a profit over there. And with the money that's staying inside the insurance policy, that is still growing as well. So think if you're maybe earning, I don't know, 5, 10% on that money for making 10% on it, you're paying 5, you're netting 5% interest on money that doesn't technically exist. So that is the infinite banking concept. That is the concept of utilizing life insurance to become your own bank. I know a lot of people haven't heard about it. If you have, I will say honestly, if you haven't heard about it now, you're probably living under a rock because it's literally all over social media. It's all over everything. Everybody is talking about it. But there is quite a few different insurance companies that do them. The best one for you will depend again on your age, your health history, and your background, and how much you're looking to save, and how quickly you need that money back out. But ultimately, that's going to be the gist of how it works, right? And a lot of people will ask me, well, am I borrowing from the death benefit? No, you're not technically borrowing from the death benefit. You can only borrow how much money you have put in or that it's accumulated or grown to. You're not borrowing from the death benefit. So the key is the more money you put in quicker, the faster you will have access to take money back out. So hopefully that helps. If there are any questions, I'm happy to answer them. I have not seen anything pop in, but that's the basics on the concept. And I do a lot of videos like this on my channel. So if you're not already following me and you'd like to see more content like this, I am happy to be answering any questions that you have. I do put a new video out every single week, and I'm always looking for new topics to cover. So hopefully, again, this helps. And I look forward to seeing you guys later this week on YouTube.